So this is the model I shared earlier or sometime this year, where there's a range, price sweeps below it, sweeps above it, and then wait for a retracement to go long, right? For his study. So I'm only doing this because after I shared this model, that last video from ICT was very, very inspiring, because for the persons who actually test this theory here, you would see that this is essentially what ICT taught in that last video. The difference is most persons who see this, they're limiting their view on this area being this huge magical range, like Asian range. Even though it's possible with Asian range, that's not it. It's a conceptual idea. A range is specifically a range of price for this example, but that's not the only range in the market, right? No. I'm not teaching any of the model like that. But this range does not necessarily have to be an extended period. It can be a candle, and it can be an entire range, like Asian range. It could be a session range, right? So what's important to understand is that this is what it looks like. Now, when they add another layer of understanding to this, right? I'm gonna add another layer of understanding to this model right here. That's gonna make you see it much better. Now, let me add another color. Call this blue. Now, essentially, if you look at this right here, you can look at it as the pattern that we all know, like AMD, accumulation, manipulation, distribution, or stop hunt, breaking market structure, and RTO. If we look at it in that light, this becomes a reversal model. Okay? If you look at it in the context that this leg down is a stop hunt, this is a breaking market structure, this is a RTO, this entire entry model becomes a reversal trading model, if you want to put it like that. All right? Now, let's add something else to it. I'm not going to teach anything new. I'm not sharing much new. All I'm going to do is flesh out what you're seeing here. So, in the context that this is a reversal model, it would mean that price was previously bearish. So let's assume that somewhere up here there's an order block. That's an order block right there, right? And price is expanding lower, like so. If the market structure was bearish before the reversal point, it means that this should have some sort of bearish market structure. And we already know what a bearish market structure looks like. Lower highs, lower lows, lower highs, lower lows, all that good stuff until we get to this range. Once we get to this range, then what? Here's the range. Here's that sweep below the range. So from here to here, this becomes our trading range. This little segment right out here, this part here, becomes a stop hunt. This is a stop hunt of this range. Then this would have been what we would look for as breaking market structure, right? And then this would be like that RTO. Now, in the model ICT taught last night, and this is not to impeach on anything ICT did, this is just to share my thoughts on this and add some understanding for persons who are following me and follow ICT as well. So in the model that ICT showed last night, we mentioned that there is this area here, but then for him, he identified this all as an order block, and then changing the state of delivery, all right? And I probably end up know what that is. Then that trade down inside a fair value gap that's existing right here, right? So that would have been your entry, and then this is your target. So most persons know, if you're bullish, would be looking for price to go back up to that bearish order block. And then if the market is bullish, then obviously it should destroy this bearish order block and continue pushing higher. But what if the underlying opinions of the market is bearish? What's going to happen here when price does all of this good stuff back to this order block? It's going to tank lower like this. This right here is way more powerful than you realize. Not guaranteed max funding. Now, there is risk in trading. There is a lot of risk in trading. But this idea here can teach you to sit on your hands and literally do nothing. Nothing at all. The two best entries or two best trade setups are going to be formed right here. I was trying to draw a circle right here, right there, and right here. It's that simple. You're buying to selling, or you could literally do nothing and wait for price to trade here and then sell it. So we're gonna scrub through a couple charts, and this is the context that we're going to be looking for. Just this model right here. Add some understanding based on structure, help it come alive. I'll clear this off now. All right, so this is a 1 hour chart. While I can, I've got stuff on it before. Clear all of those off. Okay, so let's take a look at this in here. And we're going to try to see if this idea was applicable anywhere here. So the market is bearish here, coming down, right? And we had a reversal right here. The reversal took out this low, right? That little portion of price action will be your stop point. So then we're looking for an order block that started an expansion down that gave us a bearish market structure. Now this is hindsight. I'm literally picking an example of this model. Yeah, I'm gonna post the recording. We're looking for an order block that puts this into context. So now in hindsight, I can see this order block right here using the highest one. I can see that order block right there. Okay, so if I can see that order block right there, then all of this becomes your bearish market structure. This is the reversal point. This becomes your entry to go long, and that becomes your short entry, just like that. So without doing anything, without trying to force your will on the market, trying to predict anything, all we're going to do is manage the risk around these points. Literally, nothing else. So when price breaks above here and comes back to this point, if we're going long, then let's assume that we entered off this order block right here. Our stop loss is going below the low, and our targets are going at the low of the order block for safety, because you don't want to see price trade above the order block if this is the fractal that you're trading. So get comfortable exiting like just at the order block so that you can get ready for your short position. So now this idea alone gives you a 4-to-1 trade idea. I'll take that off. Now when price gets here, if you're aggressive, you're selling the minute price trades up into this order block here. You're just selling that and managing the risk with your stops above here. Now, if you're not that comfortable, again, we could just trade this order block. If you trade that order block, then your entry is right there, the order block. Stops above. And we're looking for price to trade lower to break this. So this entire trade plan becomes a 5 to 1. And you would be sitting right now roughly 1 to 1. Just this idea alone. So if you're a scalper, imagine what you can do with this idea. Just imagine what you can do with this idea, because this trade is already roughly a 50 pip trade. Okay. So let's drop to a lower time frame. Let's go 15 minutes. Standard deviations still valid. Well, since you asked, let's take a look at that. I could answer, but let's take a look. Okay, so when we're looking at standard deviations, it's always standard deviations of the range. Now, I have not customized my fib on this guy here. Settings. It's been a while. And I think it's this. Let's see. I'm not so proficient to trading view. So what? I'm gonna do what I know how to do. I'm gonna grab a box, put it around the range like so. I'm gonna clone the boxes. Check if it's gonna work. It's not working for me. It's not working. I'll leave when I go to a lower time frame. So just to be consistent, I'll just stack the range right there, and let's go to 15 minutes. So the answer is yes. You can still use your deviations to line up with your targets when you're using this. So now let's refine our range. It's right there. Let's go. Bam. So 2 deviations, or roughly 2 deviations to your target. 1 deviation lower gets you here. Nowhere near. So the premise for ranges like this is if the range, let me not leave that part. I'll just leave that for you to figure out. If the range is too big, then you have to modify the range. If the range is too small, you have to modify the range. Right? Leave that to your understanding. So now, using just these deviations, once we have price breaking below and above, at this point, we become bullish. So inside here, we're waiting for entry patterns before we become bullish. Now, prior to ICT posting that video, we just be looking for type 1, type 2 setups in here. So we'd be putting our fibs low to the high to get an entry. This in here as a low. And I think I shared on one of my last YouTube videos that if we have a price leg like this, and inside the run, we have down candles, and there's no clear low that looks like jagged, like what we're used to, like up, down. There's no clear lows like that. Instead, we have a string of green candles and then a down candle. When that happens, you can use the low of the down candle as your low. Why? On a lower time frame, maybe a 5-minute chart or a 1-minute chart, this up and down movement is going to create this pattern. Because this is just 5 1-minute candles. So 5 1-minute candles will be way more pronounced. So using this idea right here, it's inside an order block below the low. Remember, this is the low and this is the stop one. So inside all of this, we can buy right here. And again, if you're not aggressive, you don't want to buy this, that's fine. You see an order block get created, you can buy when price trades back to this order block. So the high of that order block can be tagged as this blue line right here. Right there. So if we have the high of the order block tag, or if we have this blue line being used to signify some key level, let me take this off. It's not really necessary here. If we have this blue line being tagged as a key level, the key level would be the range low, which would be right here. Now we have a range low and a range high somewhere up here. I think it's at the gray box at the top. We have a range low and a range high. We're bullish when price closes above this this brown line or whatever this color is right here. All we're doing now is looking for entry. In an ideal condition, price might not trade this deep. We'll find other signatures in here that will give us an entry. But if price trades to this blue line, what would you look for? A reversal pattern. That's it. Because this becomes your key level in an underlying bullish market structure, because we're bullish when this happens. So at this level, we want to see reversal patterns form. All right. Now, here's a filter for how you interpret or how you look at price when it's trading at a key level that you don't want to break. Focus on the closing prices of the candles. That's a little bit vague, so let me flesh it out. If this market is bearish and it's trading low,
yes, sir.
Hi. If this market is bearish and it's trading low, once the down candles close below, you shouldn't see any up candles going back above it. So if this market is bearish and the down candle closes here, you shouldn't see up candles going above it. Now, while that much is obvious, let's put some rules to it to make it a little bit more precise. So once you trade to this blue line, if we're bullish, we don't want to see green, the up candles here with closing prices that are above it. If the closing price of the green candles form at the blue line are above the blue line, then this is not bearish. I go bearish if the closing prices of these green candles are below the blue line. That's a filter. You can flip that for bullish markets or the reverse of whatever I just said. There is no script. I'm literally talking from my mind now. So we want a reversal pattern to form here. What reversal pattern are we going to be looking for? Just gave you one, right? I literally just gave you one. And that pattern is this. You want to see that form. And you want to see that form, and that form, and that form, and that. That's a reversal pattern, or that's the one that we're talking about now. So at this blue line, you want to see this reversal pattern form inside this fractal that we're already trading. Somebody's probably seen it already. So we have this as our range. Then we have this as our stop point. So the low of the range has been taken. Here's the high of the range. So we're comfortable with. I focus on the bodies only. So I'm looking at it so much. High of the range has been taken. Same context. We were bullish right here, but we waited for price to trade deeper inside our range to get an entry. We're bullish right here. We want price to trade back inside our range to get an entry. There it is. There it is right there. If you didn't take it right here on this down candle, so it's messy. If you didn't take it on this candle, when this candle is going low, if you didn't buy into that, so your stops below here, and this is way more convincing because that would have been a much clearer break, both above and below your range. There. Where's the liquidity? But it should be obvious now. We have these eyes in here. We have this order block that we might need to contest with. So let's clear up this. Let's start that order block right there. You want to use all three. That's you. Whatever your trade plan is around order blocks, that's up to you. I'm just sticking with this one right here. All right, so this is the first objective. And again, if we're trading this, let's say we took it on the first one. Max stop is there. Target is at that high. See the bodies. Let's not be greedy. We're going to 2-to-1 trade setup. That's it. Hit it. Done. Now we know that this is as high as price can trade to before going lower. If we're trading just this fractal, but this fractal is a refinement of a larger fractal, right? So price is fractal. People always say that. Now you see what it means. Let's take this off. Here's our order block. So this order block can be viewed in the same way we view this blue line. If green candles are not closing below this order block, we're good. Just like that. Price comes back to it, wicks below, stop rate, starts moving higher. If you didn't buy this, then here's a return to the order block. If you enter here, let's say you didn't enter here because you didn't trust it, but you entered here this time. Let's say you were actually brave and you bought inside this candle right at the high right there. Let's say your stop is right at that down candle's wick because price traded there, so you have to be cautious. Your targets now becomes these highs at first, this level in mind. These are relatively equal highs. Using bodies for safety. I don't remember what the RR was on this, but then here's another one. Here's another trade. This is a 3-to-1. Same day? I don't even know if it's the same day. Doesn't matter. Here's a setup. This level is your order block that we're expecting price to react from. See that right there? Right there. That one. So if I can pull an ICT. What's the low on this candle? Low on this candle is I can't see the zoom thing in the way. I don't know what the low of this candle is, but it looks very, very close to the high on this candle. Okay? Listen, folks. Hashtag ICT joke. See that reaction right there? That's it. But then our objective is up here. So we know that this is liquidity engineering because this is the fractal that we're looking at, but it's nested inside a larger fractal. So the range from up here to down here still intact. You can put your fib on it, of course, and then find your equilibrium price point. And then whenever it dips into the equilibrium here, you look for your order blocks that are at equilibrium or a little bit below, and then you buy in the premium end of the discount range. This is buy high protocol. So add a little bit of madness to this. Let's say that's the range. Let's hypothetically speaking, that's the range. All right. This would have been the midpoint of the range. We tagged the order block right above the midpoint. Then we traded low. Where are our order blocks below here? No. I'm just playing, just playing. Right here. That's your order block right here. So if I take this off, I put this on order block there. It's a very small order block, so you have to have rules for when the order blocks are small. That's your order block. Your max stop loss would be below these wicks. That's factoring the order block plus spreads. These wicks. Entry, entry. Where's our target? This gray box was that larger fractal on the H1. Tags it there. That's the end of it. So that fractal that I showed you in that video I called the model, that's the only thing I'm going to be talking about or mentioning ever. Anything else is just how you refine that specific model. But only for the persons who actually want to learn this are going to put in the work. If you want to learn it, I think I've given you enough to help you understand it. So it's been a great night, folks. Hope that was able to put some stuff together for everyone. And we'll talk in the chat. Good night.